Hi fools, and welcome to another video from the Motley Fool. I'm Owain Bennallack and I'm here again to tell you why to buy the FTSE 100. This seems to be a bit of a kind of revolving door policy for me at the moment. I will honestly come on one day and say it looks expensive, but at the moment I see reasons to buy it. And the one I'd like to talk about today is inflation. Now, I doubt that you read the Bank of England's inflation report last week. Even I skimmed it, and I am an investing nerd. The important thing to see on it, and you can find it on the internet, is a graph. It's called the Inflation Expectations Fan Chart, something like that. It's the bank's central expectations for where inflation is going to go. And the big red line in the middle is their most central of their central expectations. That's where they basically predict inflation is going to go. And the key thing is they predict a rate of over 3% for the next couple of years. They think it's going to dip a bit sooner than some. But nevertheless, they think over 3%, which is above their target of 2%. So you would think at this point they'd be jacking up interest rates. That's what they would be supposed to be doing with inflation targeting. But they're not, because they think that the economy can't take it effectively. They don't want to cause a house price crash. You might think that people wouldn't trust the Bank of England's inflation prediction methodology because it hasn't actually been very accurate. But the market seems to. If you look at what's called the break-even point, or break-even rates, this is the difference between index-linked rates and conventional rates on bonds, on government bonds. That's signalling inflation expectations of about 3.2% a year for the next decade. So that's basically the city's best guess for inflation for the next decade in the UK. It's 3.2%. You might think this is all very interesting, a bit esoteric, but it has a lot of real consequences for your investing. If you've got cash in an ISA paying you 1.9%, you're not getting a return that's above inflation. If you've got cash outside of an ISA, paying 1%, you're going to be losing money, quite a bit of money every year. Another thing that could happen is sterling could fall. The value of the pound could fall, because basically people will look at this and go, the economy's weak. Inflation is going to erode the value of my money. I don't necessarily want to hold pounds if I'm an international investor. So I might sell sterling. So your value of your pound in the pocket, as they used to say, could go down. So obviously that's a problem if you go to Spain or France, but it's also a problem if you're investing only in UK shares. Relative to investors around the world, you're going to get poorer. So what can you do about this? Well, as I alluded to at the start, you could consider buying the FTSE 100. The reason I would say that is because it is paying a yield at the moment of 3.2%, which is enough to match this inflation rate. Also, companies have the ability to raise the dividend yield they pay out. So over time, the yield should go up, not like by a specific amount, and for any particular company there may be ups and downs in the dividend yield, but in general, if prices are going up, which is what inflation is, companies should be able to raise their prices to basically match that, so the yield should increase over time. I think that's a lot more attractive than having cash in an ISA, or especially outside of an ISA, paying much less than the inflation rate.